the short answer to how the industry works is the law of large numbers.
Right.
So we've got $100 million in insurable risk. Do we need to buy $100 million in property coverage? The answer is no. You don't want to be caught underinsured. That's the day you wish you had an umbrella policy or some sort of an excess liability policy. They win, you win. That's what we want to happen.
Here we go. Jason, I'm so happy to have you on the podcast. I've wanted to do this podcast because for me, I've told you, it's something I really want to learn more in depth. And I think that insurance, property insurance specifically, is one of the more overlooked things in real estate. But sort of before we get into a lot of my questions, why don't you introduce who you are and what you specialize in?
Okay. Well, first of all, Eduardo, thanks for having me. I've been looking forward to this too, and we've definitely talked about it a long time. So it's just a pleasure to sit down with you, and happy to take this time. So thank you. So my name is Jason Pomerantz, as you know. I am what you call a retail insurance producer. Mm-hmm. So that's a fancy name for essentially insurance sales. And so, I kind of would categorize myself in kind of like a highly consultative sales model. Mm-hmm. I work, almost entirely in the commercial realm. I work with real estate developers, property owners, portfolio owners, general contractors. So anything real estate and construction related. I do go outside of that realm as well. I have a general counsel practice where I work with general counsel from all industries, kind of in the middle market range, which, depending how you want to define that, but public companies, private companies, et cetera. And so
on insurance?
On insurance. And so, again, it's highly consultative. Really, we're an extension. We behave as an extension of their risk management department if they have one. If they don't have one, we are the risk management department. And so, I'm fortunate enough to work in a fairly large organization, at least by Colorado standards. About 3,000 associates nationwide. Wow. And we are nationwide, headquartered in Denver. And so we're able to address every vertical of every industry and every type of insurance. And so it's just so wonderful to have this platform of really talented individuals behind me, especially in areas where I don't consider myself an expert, which are most areas. But within real estate and construction, I kind of lean in very heavily.
One thing that I really admire about you, and I'm a little bit jealous, I have to say, the people that, they study law, and then they go and they don't necessarily practice, but they use everything that they learned from their legal background in whatever business they are.
Right.
How did that help you do your work?
Well, I took a strange path to this industry. I was a client.
Oh, really? Okay.
So I practiced law here in Colorado for 22 years. And throughout most of that career, I was a client of several different insurance outfits, but most notably the one in which I sit today. And so these are people I've known a very long time and came to respect and develop friendships. And so when I was looking for a change, it was kind of a no-brainer for me to start that conversation with these people. And so now here we are 4 years later. I'm totally immersed in this world, and it's just been wonderful to get to know those people better, and then a really broader swath of the industry quite a lot better. So it's been a journey.
I mean, honestly, whenever we've talked insurance, I always feel like I'm in good hands with your advice and your leadership. So it's always a pleasure to talk to you about, the other things we have in common. But when it comes to insurance, there's just so much I don't know that when we talk, you never know what's happening. Also, I think it's important to note that you're also a broker, insurance broker. So just to give, I guess, the audience a little bit of reference, what is real estate insurance? Like, what types are there, and why should they not get it? I think everybody knows they have to get some, but what should they be looking at?
Yeah, well, if you have a lender, you have to get it. You have no
Right.
choice, which I guess from a sales perspective is wonderful. I don't have to convince you that you ought to buy it. I just have to convince you that you ought to buy it from me as
Right.
opposed to somebody else. And so, the challenge in that is there's always relationships involved. And so if I get hired, that means somebody else gets fired.
Right.
And that's something I take very seriously, and it's sort of the tough part of this business, and that's a two-way street. If somebody else wants to hire their brother-in-law, that means I get fired,
Right.
And vice versa. And so it's challenging. But the way we win business is really by showing our expertise, and really flexing the broad team that we have, and in whatever vertical we're in. The team is what shines
Right.
for me, and I'm only as good as our team, and in that case, that I'll take that all day long because we have such good teams in this organization, and so it's just been fun exploring externally, but also internally, to meet great people and develop these relationships, and mate the external relationships with my internal relationships, and that's really been the reward for me.
Right. Okay.
And so I do
Yeah.
want to complete the answer to your question, and what types of insurance are there in the real estate realm. I mean, there's the major categories are property and casualty. Casualty, otherwise known as liability. And so if you're a property owner, if you own an office building, let's say, or a retail building, you need property coverage for the standard perils of fire, water intrusion, things of that nature, that we can all get our arms around. Anyone who owns a home
Right.
knows they have to have homeowners insurance, theft,
Yeah.
etc. That's what your property insurance covers. And then conversely, on the casualty or liability side, covering your exposure from third parties.
Okay.
So we talk, I'll get a little jargony in our conversation just so you can understand how we think about these things. But property is what we call first party coverage.
Okay.
Your building burns down, you are the claimant, no other parties involved. That's first party property coverage, versus liability. You invite a friend over, or a business guest, a business invitee comes over, and slips and falls on something, and you were negligent, you left an extension cord out, or
Right.
something like that. Somebody trips, falls, gets injured. That is what liability coverage is for. If they were to sue you, you could make a claim on your casualty coverage, or liability coverage.
Okay. So commercial is different from homeowners policies.
Yes.
So, I mean, I don't want to jump too much around, but I do want to ask you, because a lot of people, they have homeowners insurance and then they rent out their house to somebody else. Why shouldn't they do that? Or do you see a problem with that? Is it a different kind of coverage? Does that now become a commercial?
Yes, is the short answer. I mean, you definitely want to talk to your insurance agent if you have, your primary residence, and now you want to start renting that out, whether on a short-term or a long-term basis. You want to make sure that you have the proper coverage for the third-party exposures. And so I guess the reason behind that is, the carrier underwrote that policy when you bought it as your primary residence. They underwrote it as a primary residence.
Right.
If all of a sudden now you're going to turn that into some kind of a business, as an Airbnb, short-term rental or long-term rental, they need to know about that, because the exposure is different. They're going to rate it differently. It's probably going to cost you a little bit more.
Right.
So that's definitely a conversation you want to have. The thing that you don't want to happen in the insurance world is that you're now, based on your behavior, falling into some exception in that coverage. And so, the exclusionary language can be broad in a lot of these policies. And so always consult with your agent, make sure you have the right coverage.
I definitely wanted to get into exclusions and inclusions to look for, just because, it's a contract that you're signing, and you're making a deal with an insurance, and you're buying a protection, and
a very complicated contract.
Yeah, I mean that's why, one of the questions was, why do you need a broker? Like, if people could just find themselves, what is the benefit? And I believe very strongly in having brokers. I use car brokers. I don't, for cars, I use brokers for insurance, even real estate. I'm a broker. I don't represent myself. I usually have a broker.
Yeah, I mean, you would not enter into a complex legal contract without consulting a lawyer. So likewise, like anything else, I mean, you need an experienced guide to make sure you're buying the right thing. And so in every single state, insurance agents are licensed. And that's just the beginning. I wouldn't make that your criteria, right, that we all have to be licensed. You want somebody with a certain amount of years of experience, and that is hopefully, at least in part, in the area in which you're considering. Real estate is a discipline within the insurance industry. So you want to find someone who's pretty seasoned in the real estate world. And so, with the larger company, we have the luxury of all our different teams and our specialty practices. And so, if you were to come to me, whatever the need you had, I would be able to tap the right people internally and bring that expertise to the table. And so, with a smaller agency, people tend to be a bit broader. And for, basic property risks and things like that, that's fine. Right. As we get into more complex commercial risks, maybe not. It just depends on the situation. And I'll contradict myself. I mean, there are some, niche brokers that focus exclusively on, say, construction. Right. And those folks tend to be fairly sophisticated, and you would be in good hands. But always check references. Do your diligence on who you're visiting with for any kind of insurance brokerage.
What are you looking for when you do your diligence?
Years of experience.
Okay.
Perhaps some references from people that are similar enough to you. Ideally, someone who's maybe more sophisticated or larger than you in terms of their real estate holdings. Yeah, might be somewhere you want to start. Someone who's been in the business a long time, and then you ask that person who they use and who they might recommend, and then go talk to them and see if there's a connection. See if what I would suggest is, a telltale sign is, see if they're interested in your business and learning more about your business and your concerns and your plans into the future, as opposed to just simply having you fill out an application and trying to create a transaction immediately. Okay. The transaction is a necessary consequence, but we want to have sort of an in-depth understanding of your business first. That's my opinion. Yeah, that's how I like to do business.
I mean, not to get into trends yet, because I do have some questions about that, but I feel like also having a broker, things are constantly changing in the business. Hurricanes are picking up in Florida, or there might be more snow in Denver, or, there's lava in Hawaii. There's so many different changes, just natural disasters is one category of changes. That having an expert, as a real estate owner, you can't possibly keep your eyes open in every field that you need to be, capital raising, financing, insurance, everything, the law is changing. There's so many things changing that having an expert within the insurance industry, and it's a lot of money, I think, if you don't have the right insurance or you don't have the coverage. One thing that, and I'm going to go back a little bit to what you were talking about, commercial versus liability. One thing that confuses me is that a different policy? Then you have, what categories are there? Because you have like losses of rent, insurance. You have builder's risk insurance, which I don't know if that's an add-on or a specialty. What categories are there within in real estate?
Right. So I mentioned before that we have the two broad categories of property and casualty. Again, casualty is otherwise known as liability, and so on the property side, there's all sorts of sublimits and coverages within that. And depending on the type of policy you buy, their loss rents could be part of that. You mentioned builder's risk. That is a very specific type of property insurance that you would purchase during the construction phase. So that is your property coverage during construction.
Oh, it is? Okay.
And then once construction, if you were building from the ground up, let's say, a new building, you would have a builder's risk policy during construction. Once construction is complete, you would then transition to a permanent property policy.
Okay.
So, builder's risk is its own specialty. There's people here that's all they deal with. And so, again, you mentioned all the different disciplines as a real estate developer or owner that you need to, at least be conversant in. I mean, likewise, on the inside in insurance, the same thing is true. It's gotten so complex and so highly specialized. That's why we have all these different specialty practice groups that I mentioned.
Right.
And having that ability to bring in those groups as appropriate. So, I almost become an internal navigator when we have, complex clients where they might have property risk. They might have a directors and officers concern, if it's a larger company, cyber risk, cyber liability. I mean, we have a whole department that's all they do.
Yeah.
And so, I keep mentioning these two broad categories of property and casualty, but there's all these other kind of more niche products like cyber liability, for example, that, need to be part of the discussion at a minimum.
It's so interesting to me how so many property owners, being from California and having properties there, a lot of people don't get earthquake insurance. They have all this other coverage, and I understand it's a huge premium, and it expires after a year. But what happens if you have an earthquake and your building gets demolished? You know, what kind of recourse does a landlord have if that happens and they're not covered?
Right. Well, I mean, that would be a component of your property coverage, and people in Colorado typically do not buy quake coverage for obvious reasons. Right. But in California, I think you'd be remiss to not spend that money. And so, I encourage people to think about insurance as kind of a risk finance device. I mean, you could assume that risk yourself.
Yeah.
And, in most years you will have no cost. But when that large, catastrophic loss happens, you're going to wish that you had spread that cost over many years in the form of insurance premiums that didn't pay you back anything for that one day where you absolutely need it.
I mean, I think that's key to look at it that way, from that philosophy.
It's risk finance.
Yeah. And I see why you would need a specialty group, because they could analyze they're looking at the risk. If you might not understand the structural needs of an earthquake in California, because that's not, there's very specific, like, was it retrofit? Was it, how was it retrofit? What materials maybe affect if it was properly retrofitted? So one thing that I'm also personally curious about is just, how does the insurance business work? This is more like if you're a landlord trying to get a policy and you want to look at it. But where does the money come from? I mean, I know they're insurance companies, but what are they looking for? What kind of, is it that they're looking for returns?
Yeah, well, they're in this business, truth be told, to make money. It is a for-profit industry in most cases. At least it's designed to be. For a number of years, it was a money-losing operation industry-wide on the carrier side. And they did not properly forecast all the catastrophic losses they were going to have, with the Florida hurricanes, the western wildfires, etc., floods. You name it. You can imagine quickly in one of these large events, you hear, on the news, these multi-billion-dollar losses. I mean, there's only a handful of companies that are eating the lion's share of that loss. And so, there was a great slide I saw once that showed a dollar bill kind of cut up to where your premium dollar goes. You'd be shocked. A small sliver of that was profit.
Really? Well, yeah.
The lion's share of it is claims. They pay out claims, believe it or not. Most of that premium dollar gets paid out in claims. And so, there's a concept I learned early on in the insurance industry called the law of large numbers. And so it's a very simple concept where, we talked about that risk, the risk finance of that single catastrophic loss that you're preparing for as an insurance customer. If they have enough customers, all the rules of statistics that their forecast models ought to work. And in most cases they do work. so long as they have sufficient numbers of insureds under their program, and if they've underwritten properly and excluded, the unreasonable expected losses, then everything should work. They will keep their small amount of profit. They will pay out the claims, within their expectations, and everything works just fine. They win, you win. That's what we want to happen. And so really the short answer to how the industry works is the law of large numbers. And then when they have retained earnings in the better years, they invest those earnings and earn a return, which bolsters their coffers for when that bad event happens in those major catastrophic years.
That makes a ton of sense. So question about there's another thing about being an agent, I think. Is there a lot of competition? I always see I love having agents because they're my gatekeepers, they're my communication, they're my presentation to the companies. Is there a lot of competition within the insurance? Like
at the retail level where I sit?
Yeah. Not brokers, but like providers.
Oh, on the carrier side.
Yeah.
In most cases, yes. It depends on the industry. I mean, if you're talking about, inland, property risk, sure, there's tons.
Okay.
When you get into coastal and cat areas,
what's category?
Catastrophic.
Okay.
Think Florida.
Okay.
Think coastal Florida, coastal Texas. Gulf Coast.
Yeah.
Where we have all these major catastrophic losses. The carrier, the competition has dwindled.
Yeah.
I mean, there's only so many carriers that will play in that arena. A bit closer to home, I deal with a lot of multifamily construction. And in Colorado, we get to brag about being the #1 worst state for construction defect litigation. Right. And so I can count on one hand how many carriers will write the construction insurance policies for condominiums. We could spend 2 hours talking about condo litigation in the U.S., particularly in Colorado. It's really bad. We could talk about California with the wildfire risk. I mean, you hear large carriers that have pulled out of that state due to the unacceptable wildfire risk. They just can't do it anymore.
Right.
And so every time you lose one of those competitors, the premiums go up. I mean, it's simple supply and demand, economics. And so there's a reason why we've seen our property rates climbing in double-digit numbers for the last 5-6 years.
Yeah.
Luckily, this year we've seen some pullback in the property rates, which has been welcome. But we're pulling back from historic highs and coming down a little bit.
Yeah.
They're still pretty darn high, so don't get me wrong. But that relief is welcome for our property owners.
Yeah, I mean the risk makes sense. There's a lot of unknowns that are happening. One thing I was mentioning when we were by the elevators that I wanted to tell a little story. It's not a story. I owned a property. It was vacant. Getting insurance was so difficult for vacant properties and then we had vandalism. And it only covered theft, not damage, or damage, not theft, something like that. And we had that. And I remember it was such a hard experience to get compensated. Why is vacant property insurance? It's something I'm scared of now.
Yeah.
Is vacant property insurance difficult to get insurance for?
It is. So I oversimplified the industry in talking about the law of large numbers, but it's also the law of small numbers. They are record keepers. The insurance industry is better record keepers than our governmental entities or anybody else. Because it's their bottom line that's on the line.
Statistics, yeah.
Exactly. And so, they've got actuaries and data scientists involved looking at risk, past performance as a guide. That's all we have, right? And so they typically look at 5 years in the past, sometimes more than that. And they're looking at you as a property owner yourself. What kind of loss history do you have? Are you, a mindful of your properties.
Right.
They look at the geography. Is that particular zip code prone to certain types of claims? And then kind of broadly, what are we seeing trend-wise, either in that state or across the country? And one thing that is clear to them is that vacant properties see more claims.
Right.
We have vandalism risk. We have leaky pipes that go unnoticed for weeks or months that cause tremendous amounts of damage. And so, vacant properties just are a peculiar kind of risk, just because of their nature.
That makes sense.
Yeah.
I mean, that answers one of the questions, and it's one of the key questions. What do insurance companies want to see? That's a big part of it, because you want to be insurable, and you want to prepare for that. It's something you have to underwrite, something you need to think of. I really do feel that people are not educated enough on insurance. I think it would help to have insurance, or to have a good agent that explains a lot of these things to you. So a common problem that I've heard about, and this happened in one of my properties, was being underinsured. And that probably happens very often, because you don't think of construction costs going up. You're not getting a bid every year to see how much things cost or anything like that. How does that affect a landlord? I mean, when it comes to getting money in return?
Yeah, I mean, when we're talking about replacement cost, it's really important that you update, the insured amount for the building pretty regularly. Every year might be a little extreme, but I would say at a minimum every 2 years, you want to be looking at that. Construction costs. I don't have to tell you, they've been going up dramatically, outpacing broader inflation for many years now, and so you don't want to be caught underinsured. And so the industry has tools. The Marshall and Swift guide is a tool that we use, where we can say, okay, you have a retail building in a certain zip code, a certain type of masonry construction, and a certain type of roof, and we can do some cowboy math and come up with within a pretty decent margin of what replacement cost for different things is going to be on that building. And so, but I wouldn't stop there. I think especially most of my clients are seasoned industry professionals, and so we might use those numbers as a tool to start a conversation. That's not the end of the conversation. And then we want to talk about, well, what's peculiar about this building, what's irreplaceable, etc. What sort of onerous things is the municipality going to impose on us in the event of that we have to do some reconstruction and bring things up to code.
A lot of people talk about an umbrella policy and maybe getting insurance, one policy for all their properties. Why is that a mistake, and is that just not the way to do it? Yeah,
let me address the jargon. When you're including multiple properties under a single insurance policy, that's a master program. An umbrella, conversely, is sort of an excess policy that sits over other policies as your primary. So, for example, let's say you have a building and you have a casualty coverage on your building for slip falls. You also have an auto policy for some cars you have for your business. Business vehicles. You might buy an umbrella policy that would sit in excess over all of those. So you have $1 million in GL coverage for your building. You have $1 million in auto coverage, and then maybe you have a $5 or a $10 million umbrella policy that sits above that for if one of your employees, God forbid, takes out a carload of people and injures or kills them. You would have millions of dollars in potential claims coming your way. That's the day you wish you had an umbrella policy or some sort of an excess liability policy. So two different categories. So your original question, was about master policies covering multiple properties. I'm a fan of that. Once you get above about 5 substantially sized properties, it starts to make sense.
Okay.
And so most of our clients will buy one-off policies until they get to that level. And then we can start talking about a master policy where we can think about loss limits. So let's say I have 10 properties, roughly $10 million in insurable value each. So we've got $100 million in insurable risk. Do we need to buy $100 million in property coverage? The answer is no. If we can convince your lender to play along, maybe we buy $50 million. Unless they're all situated in the same block of the same town, they could all theoretically burn down in the same event. Then you'd probably want to insure the whole value. But if they're spread across, a broad enough geography, and we have what we call spread of risk, then a master policy with a lower loss limit makes a lot of sense. And so we can kind of lower it from the top end and really bring your premium cost down and still provide fairly robust coverage. Then conversely, you could think about on the other side, let's say you're an established family office, property owner, portfolio company, etc. And you've got decent cash reserves. Maybe you're comfortable taking on a little more risk. So we can look at higher deductible programs and kind of squeeze it up from the bottom end as well. So we're compressing from the top with a loss limit that I was describing. We can compress it up from the bottom with higher retentions, aka deductibles, and really save you some money. But again, it needs to be a very eyes-open, consultative discussion between you and your agent.
That makes complete sense.
So you can't have a surprise on the day you have a claim. I mean, there needs to be, a very kind of open conversation with your agent, and that's why that relationship really matters.
It really sounds like you have to be educated to understand what you're signing. I mean,
it's not for everybody what I just described.
Yeah.
It's just not. And that is never my opening salvo in one of our conversations. I mean, this is something that I would tease out of somebody over a long conversation about risk appetite and plans for the future, etc.
But it's all you kind of should know everything, even if it's standard, because it's a negotiation with the provider. You need to know what's covered, what's not covered. I mean, I think it's your responsibility as a landlord to sort of not just to sign, and I mean, it's good to take the advice, but to understand what is and what isn't. So what mistakes do you think landlords make when, this is where the question is coming from. When I was starting out and I was buying apartment buildings, you would see these pro formas, and the pro formas would be, the insurance for like a 6-unit apartment building in Beverly Hills or whatever would be $1,200 or something. It's like, and then I would go to my agent at the time, and it would be like $15,000 plus another $25,000 for earthquake. I just didn't understand, how do you get 10% less, costs, or more than 10% costs? What was I missing? What did people miss?
You're not missing anything. What the scenario I keep seeing over and over and over again is, one of my more institutional clients is acquiring a building from some family that's owned it for 100 years, and they've got grandfathered insurance with a company that's just kind of kept renewing over time and forgot about them. And, that insurance is not really available anymore. Either that carrier doesn't write that sort of insurance in that sort of geography anymore, and they're just not a player anymore, so we got to go out to the market at today's rates. Or they're still a player, but just not at those rates anymore. And so there's plenty of situations where I found that the incumbent carrier is kind of asleep at the switch.
That makes sense. Okay.
Or maybe the claims history was clean, and so they left it well enough alone. And now that the property's changing hands, everything's up in the air, and so that is just not available anymore. And so over and over and over again, I see people, underwriting these things based on the seller's historical insurance cost. That is, 1/3 what today's market is. Maybe sometimes worse. And they're just in for a rude surprise. My more savvy clients, they call while they're underwriting, before their earnest money goes hard. And they're vetting those numbers. And, I usually have to, give them the bad news that, hey, that rate is no longer available, and then the challenge becomes convincing the seller that rate is no longer available. And when his reality is, well, it's absolutely available. I renewed it a month ago. So what the heck are you talking about? You need a better agent. Talk to my agent. In which case that agent's like, yeah, no, I can't replicate that. So there's this kind of tug of war happening between buyers and sellers that, everyone knows about the tug of war where the seller's anchored at this high price on his building and the buyer's anchored at, a more market-driven price. But the same thing happens with insurance, and when you apply cap rates, it has, an outsized effect. It really matters on the bottom line.
Yeah, that makes a lot of sense. It's a business. That's kind of correct. So speaking of the business and all these, typical things, do insurance companies get creative with what they provide? If you go to a broker or an insurance company and you want some kind of rental income protection or something that's kind of not typical, are they creative? Are they flexible? Or is it pretty much set in stone, the types of...
rental income protection is available, but the answer to your question, do they get creative or do they think out of the box? The answer is generally no.
Right.
They work on the law of large numbers. So if you have this really neat kind of niche-y idea, that doesn't work.
Right.
If they can't sell, 100,000 of those policies to 100,000 very diverse customers across the country, then it does not make sense for them. And so, just by its very nature, the industry kind of shuns creativity in a kind of a perverse way. I think I'm thinking of it in a perverse way, but it does make sense when you think about the actuarial science that has to undergird their underwriting. It makes a lot of sense. Now, if you're big enough and you have a huge enough risk with a huge enough premium, we can work with Lloyd's of London and things like that to come up with very creative solutions.
Yeah.
But for your typical property owner, that's out of reach. We've done some major projects for some marquee like stadiums and things of that nature where creativity is allowed. On that kind of a scale. And it's a monumental effort, and it is doable. But if you've got a typical office building, retail building or warehouse or something like that, it's just not in the cards.
It makes sense because you're asking a company to put their resources into something that's not typical.
Right.
And it's going to cost money, so you have to make it a convincing argument that it's worth them investing into looking into that.
Right. But I will say that, the creativity does come in on the margins. Okay. So if we go back to your vacant building example, if you came to me and said, look, I have this vacant building, it's in a high crime area, we would run some crime scores and things like that to vet that first of all. And then we would come up with a plan, or I would encourage you to work with us to come up with a plan. So we would bring in our risk control team, and we would come up with a series of recommendations, some of which might be fairly cost effective, others might be, out of reach, expense wise. But we would come up with those recommendations, figure out what was economically feasible for you, and do a plan. So let's say we want to install security cameras. We want to hire, a company that does active monitoring. That's, they're watching those cameras. They're not just waiting for an event to happen to address after the fact. That doesn't work. We can put water leak detectors in the building and try to, and then maybe some fencing and lighting solutions and things like that. Registering, that with the local police that it's a vacant building, and maybe they'll do a little more drive-bys than they otherwise would, and then they'd be alerted if they saw human activity at night, let's say, that, hey, that's not supposed to be there. And so by implementing these things, we can proactively work with the carriers to just show how you kind of rise to the top amongst other risks, and hopefully get some more quotes for you and have a more competitive process for you that hopefully yields a better outcome for you. So I think there's room for creativity between property management, property owner, and insurance agent to work together to come up with a plan that works.
They just want to be taking, their risks to be mitigated by some level, which makes complete sense.
Yeah, it's the difference between just filling out an application and really being proactive to try to rise to the top, because they get a lot of submissions.
Yeah.
And they all tend to look the same.
Yeah.
You don't want to look the same.
Right.
No.
That makes sense. Do you think that so one question, and I think this could apply to a lot of people looking to invest in real estate, is there a specific kind of property that maybe has more risk that another, I was looking at a house in Evergreen, for example. I think that it's very hard to get fire coverage there if it's a wood built house, because it's wood and fire. So is there certain types of properties that you would think to stay out of as an investor?
Well, I mean, residential tends to carry more risk.
Okay.
I mean, you've got human occupants there. Many things can go wrong. However, from an investor's standpoint, it's very attractive. I mean, people need to live somewhere. We have a shortage of housing, etc. And so, I'm not here to make your investment decisions for you, but I ought to be at the table.
Right.
And so you can make an informed decision. So what we can do is if you're, in the property selection phase, we've got a lot of tools at our disposal. I mentioned crime scores.
Yeah.
I could run a crime score for you and see if it's a high crime area and how the insurance industry is looking at it.
Right.
That might inform your decisions. Likewise, I can run wildfire scores. So you mentioned Evergreen, Colorado. Like, let's run a wildfire score.
Right.
See how the industry is looking at that particular property.
Yeah.
And granted, those scores are driven by these maps that are very low resolution. And, we have people on staff. We have a certified wildfire mitigation specialist on staff. And so for some commercial projects where we had, the wildfire scores are rated 1 to 100. I mean, we were at, anything north of a 65 or so is considered bad. And so, I mean, we were getting scores in the high 70s on a project we were looking at up in the mountains, and we were able to create a wildfire mitigation plan, and really make a presentation to the carriers that, look, not only are we going to be proactive in X, Y, and Z ways, but this property is really well protected. We have, an interstate on one side, we have a local road on the other side. You have all these other natural and man-made barriers for the wildfire risk. Really, that score was unwarranted in this case. We made this case strongly. Enough carriers accepted that case, and we had a competitive bidding process that turned out well for the client.
That sounds so interesting to me because, when you think broker, you think that they know the carriers. I guess that's the technical term.
We do know the carriers.
But you also do your own analysis, which in a way you're like an insurance company in this sense. Maybe you don't provide the insurance, but if you're underwriting these different variables of properties, then you're acting in a way on behalf.
I would think of it as pre-underwriting.
Right.
I mean, we want to pre-underwrite the risk. Anticipate what those carriers, because we know them well in most cases. We want to anticipate what their concerns are going to be and head them off.
Yeah.
And address them and say, all right, you're right. This property is risky for these reasons. Here's what we've done to mitigate it. Here's why the canned wildfire scores, etc., are wrong in this case, and make the case. And
you're representing on behalf of your client, so it makes sense what you're doing. I mean, to me, it's fascinating how different businesses within real estate, they're on the same page. The owner doesn't want the house to catch on fire. The insurance doesn't want the house to catch on fire or property or whatever it is. So you're on the same page of wanting to mitigate. If you have a vacant building, you don't want somebody to break in.
Correct.
So what are you going to do to be on the same page? I mean, the profit maybe and the value going up, that's maybe more on the landlord's better more in the landlord's interest. But in terms of like risk mitigation, it is very similar.
Well, and selfishly, as an insurance broker, I want my clients to be long-term insurable. And
Right.
that means
Yeah.
not having a ton of claims.
Right.
The frequency and severity of claims is the path to becoming uninsurable.
Right.
And when that happens, I have no client.
Right.
You have no insurance.
Right.
Nobody's happy. And so it's in my interest to keep your nose clean. So that's what we do. That's why we have a risk control team.
Yeah, that reminds me. I don't want to go too much into the Los Angeles fires, but a lot of people didn't make claims with smoke damage because they just didn't want higher premiums. They didn't want to be uninsurable because it was kind of a mark on their, and something that isn't a big mark. Still, they just didn't want the mark on their record, I guess.
Right. Well, and like our risk control team, we have a claims advocacy team.
Okay.
So when that unthinkable event happens, which is totally thinkable, we have a team that will guide you in either making the claim decision to make the claim or not, how to make the claim, how to properly characterize the claim, what background research needs to be done to support the investigative effort, and we're there throughout the process. And so that part is critical. And anyone in investigating a new insurance agent ought to ask about what do I get in the event of a claim?
Right.
What sort of advocacy do you have? What does that team look like? What is their experience in dealing with these carriers in my type of industry?
That's a huge value.
Particularly if you're in a high risk industry, manufacturing, construction, etc.
That's true.
And any kind of real estate.
I mean, having that backup and having that confidence, I think, from a broker it's invaluable. It's worth its weight in gold because you need to have that communication also because the carriers trust the broker to a certain degree, because they want to keep doing business.
Some more than others.
So yeah, I'm sure So what's the most satisfying part of your work?
I'll give you two answers to that question. I mean, number one is sort of the consultative approach, and kind of it's a collective problem solving that we do with our clients. That's very rewarding, but really, and so that's the kind of the intellectual side.
Yeah.
But the real reward for me has been the relationships.
Okay.
And that goes two ways. The first way is outwardly, and that should be pretty apparent, where I get to work with people that I like, that I seek out and want to do business with, and someday hopefully they choose that they want to do business with me, and so I develop those relationships both before they engage me and after.
Right.
And I get to know their business and kind of live vicariously through the interesting and creative things they're doing. So that's rewarding. But likewise, internally, I work for a large company, and we have these industry experts in all these different disciplines that are just wonderful people, really good at what they do. And so I've enjoyed, getting to know those folks on the inside as well. And the best part is when I get to, marry those two together.
Yeah.
And introduce people I like on the outside to people I like on the inside, and watch those relationships blossom. And then I just kind of, take a back seat, at least temporarily, to watch that flourish. I mean, it doesn't get any better than that. I mean, that's really been what's the it for me.
I could see that being a good life sort of enjoyment, connecting people.
Yeah.
So I don't know if you guys do bonds and securities like that. Do you?
We do. We have a surety group here that's dedicated to that practice. I mean, we do payment and performance bonds for contractor clients. That's a big part of it. We do fidelity bonds for our employee benefits clients, and the list goes on. But I think payment and performance bonds are probably the most common, and it's a tremendous practice. We have a whole team that's all they do.
I almost didn't want to touch on that because it's so different and it is very niche, but it's extremely, there's so many risks in construction and having performance bonds and all these. I mean, there's so many different types of bonds, but I don't know if it works in a similar way. It is an insurance. It's just a different name for a specific type.
Yeah.
So is it the nature of the business similar?
It's actually very different.
Okay.
I liken it more to a lending relationship than an insurance relationship, because they're really underwriting the balance sheet of the company and in most
Okay.
cases, the balance sheet of the principals of that company,
Right.
because they need to guarantee it.
Yeah.
Except in in the case of very large companies with a lot of liquid assets, and so that it's I mean, we have our property and casualty business, which is very large. We have our employee benefits business, which is a whole other side of the insurance that we haven't even talked about. But then surety is kind of its own unique beast, and so it's very much like a lending underwriting process where they can get comfortable to a certain bonding capacity given the balance sheet of the the principles behind it.
Yeah, I mean, just with litigation and construction, I've had to educate myself a lot more on it, and it is a solution for a lot of issues that landlords may have if there's potential lis pendences put on properties or liens put on properties. How do you get out from under that? If you're in the middle of a construction project,
Right, life
you have a
needs to go
lien,
on, right?
You can't sell it, you can't refinance it, which is you need the money to pay the contractor. It could be a major problem. So that's one answer to that kind of problem.
Right. Well, so everything I was just describing about the relationship, multiply it by 10 when it comes to the surety relationship.
Yeah.
Because it's necessarily intimate and personal, because we're getting into, the principles of the company and their personal assets. And in certain cases, their spouses have to sign as well, depending on how their assets are situated. And so it's very personal, very intimate, very confidential, which just elevates the trust factor that just becomes that much more important.
So just so that people watching, if they don't know what bonds are, because I was I've been in real estate since I was a kid. I didn't really know what a bond was. How do you define what that means?
Well, it's classic risk shifting. I mean, just like insurance, you're shifting the risk of a fire, let's say in property insurance, from party A, you as the property owner, to party B, the insurance carrier.
Right.
Likewise with bonding, if I have some obligation, to a municipality, let's say to install some public improvements, I need to install some sidewalks, let's say, adjacent to the apartment building I'm building. The city wants to know darn sure that you are going to perform. And how do they get that guarantee? Well, they want, a big bad insurance company to step in to say, well, if Eduardo doesn't perform or Jason doesn't perform, we will hire somebody and perform.
Right.
And so, depending on the municipality's requirements, we'll set a number of dollars of what that obligation is, and that surety company will step in.
Right.
So it's incredibly valuable.
Yeah.
But you could see how, that relationship might be, super personal and fraught, just because of the very intimate nature there.
Oh, the huge liability. Or not liability, but I could see the interest there, and then you're going to be bumping heads with agreements or disagreements there with people possibly, and you need to have the wherewithal to be able to... I totally understand the reasoning behind it, but I think it's important to touch on, because that's another type of insurance that...
it's the one thing people don't think about until they have to.
Yeah.
And then they're scrambling. That's not the way to do it. I mean,
Right.
you really want to be ahead of that and build this relationship over time.
Right.
Yeah.
I mean, besides performance bonds, the one that I think of is like a payment. If you owe a sub some money,
Right.
and they put a lien on the property,
Right. You bond around
the
the lien.
you want to make sure, you bond around the lien, and it'll get taken care of. It's just not a lien on the property anymore,
Right.
so it gives you the freedom to
Yes.
do
In that case, it's a bit more transactional,
Okay.
but it still gets pretty personal, for looking into your personal finances, depending on,
Right.
the structure of the landlord. And so, in most cases, those are much easier to get.
Yeah. Okay.
And the process is a bit shorter, but it depends on the size of the lien, of course.
Yeah. Well, Jason, every time I see you, you're always reliable, you're always professional, you always look so well put together. What are your 3 key daily habits to keep yourself sort of always kind of ready for, I don't know, not business, but just ready for life?
Yeah.
Good key daily habits.
Wow, what a good question. You know what? One of those things, well, a lot of coffee.
Yeah.
Tremendous amount of coffee. That's first. But vigorous exercise for me is what keeps my head straight. Believe it or not.
In the morning or
in
after?
the morning?
Okay.
It's the first thing I do. Is
Yeah.
I'm outside in the dark running usually, or
Wow.
or something else, and I got to do something every day. And so I'm out at 5:30, 6 in the morning most days, just getting after it, and then I can kind of get into my business with my head straight. And I think number one, by doing something hard first thing in the morning, it makes the rest of the day seem easy. Not easy, but easier.
Yeah.
Secondly, there's just the general health benefits. But really it just helps set the stage by having an accomplishment. It just makes my outlook more positive, and makes me feel better throughout the day. So I would say the exercise, coffee, and then I expect to learn something new every day. Usually it's from my colleagues, in the industry, whether they be in my organization or wholesalers or carriers, what have you. I mean, I learn something every day. I learn from my clients every day.
Yeah.
Something about there's always a new problem I never heard of.
Yeah.
And then I can go investigate and talk to the smart people I work with, and do that creative problem solving part. So that's what I would say.
I love that. And definitely eating a frog, that's a statement I heard from my buddy Adam Gower. He had a guess. He would say, call it eating a frog for breakfast.
Yeah.
That was what he would say.
That's a good one.
Which is doing the hard thing.
Right.
Let's see. What advice would you have to somebody who's trying to get into real estate? Who's young or not young, whatever, but they want to get in the real estate game. I don't like calling it game, but
be humble.
Mm-hmm.
Have the humility to ask the dumb questions. Go seek out the smartest people you can find that are seasoned in the industry. Find some people that are successful in the industry. Find some people that have been unsuccessful in the industry. You can learn from them too. And learn from other people's mistakes. It's really easy to get people to talk about themselves. And you can learn so much. So do not pass up that opportunity.
What's the hardest lesson you've learned in your career that helped you grow the most?
Oh my.
That's a tough one.
Yeah.
We can skip that one if you. I don't know. There's a lot of good lessons. Sometimes the hard ones and painful ones are the best ones. I'm going through a lot of those right now. Yeah,
I've had plenty of humility pills over the years, or humble pie.
Yeah.
I mean, just too many to even get into. But again, learning from my own mistakes instead of somebody else's. It would have been a lot less painful learning from somebody else's. But we grow. And there's nothing like accelerating your growth through painful lessons like that. So we learn from pain.
Well, thank you so much for being on the podcast. Thank you for what you do.
Thank you.
You've helped me a lot. And
it's been a great conversation. I appreciate it.
It was really fun. Thanks. Well, I'll see you tomorrow night.
All right. Well, I'm trying to make insurance fun.
Yeah, this is great. This is very educational. I don't think there's anything like this out there.